Listen, I need you to pay very close attention to what I'm about to share with you, because what's unfolding right now in the gold market is something most people won't see coming until it's too late. And by then, the opportunity will have passed them by completely. You know how sometimes you get that feeling that something's off? That nagging sensation in the back of your mind that tells you the official story doesn't quite add up? Well, if you've been watching gold lately and you've got that feeling, trust your instincts. Because what's happening beneath the surface is absolutely extraordinary, and the people who understand it are positioning themselves right now, while everyone else is distracted by the noise. Let me paint you a picture of what's really going on. Over the past 18 months, central banks around the world have been buying gold at a pace we haven't seen since 1950. Not 2008, not during the financial crisis, not even during the stagflation of the 70s. We're talking about 1950 levels of accumulation. The People's Bank of China added 225 tons in 2023 alone. Poland increased their reserves by 130 tons. Singapore, Turkey, India, they're all loading up. And here's the thing that should make your ears perk up. They're doing it quietly. No press releases, no fanfare. Just steady, relentless buying month after month after month. Now, you might be thinking, okay, central banks buy gold. They've always bought gold. What's the big deal? And you'd be right to ask that question. But here's where it gets interesting. These aren't just routine purchases to diversify reserves. These are strategic moves by countries that are actively working to reduce their dependence on the US dollar. When China buys 225 tons of gold in a single year while simultaneously reducing their holdings of US Treasury bonds, that's not portfolio management. That's a statement. That's preparation. And it's not just the East. Even traditional Western allies are quietly increasing their gold positions. Germany, which famously repatriated 674 tons of gold from New York and Paris between 2013 and 2017, hasn't stopped accumulating. The Netherlands brought home 122 tons from the New York Fed. Austria repatriated 110 tons. These are countries that have been in the U.S. sphere of influence for 70 years, and they're physically moving their gold back home. Ask yourself why. What do they know that we don't? Here's where the story gets even more compelling. While central banks are buying physical gold by the ton, something very strange is happening in the paper gold market. The COMEX, which is the primary exchange where gold futures are traded in the United States, has seen its registered gold inventory, the gold that's actually available for delivery, drop to levels that should be setting off alarm bells. We're talking about roughly 25 million ounces of registered gold backing a paper market that trades hundreds of millions of ounces in contracts every single month. It's like a game of musical chairs, where there are 100 people dancing around 10 chairs, and the music is about to stop. Let me tell you about something that happened in March of 2020 that most people have completely forgotten about. When the pandemic hit and markets went haywire, something broke in the gold market. The price of physical gold in London, where the actual metal trades, diverged from the price of paper gold futures in New York by as much as $70 an ounce. $70. That had never happened before in modern markets. You had people willing to pay a massive premium just to get their hands on actual physical metal, because suddenly, paper promises didn't feel so secure anymore. The spread eventually closed, but it exposed something crucial. When push comes to shove, physical gold and paper gold are not the same thing. Now, fast forward to today. We're seeing signs that this divergence could happen again, but this time it might not close. The Shanghai Gold Exchange, where Chinese buyers trade physical gold, has been consistently trading at a premium to London and New York prices. That premium, which normally sits around $5 to $10 an ounce, has been spiking to $20, $30, sometimes $40 an ounce. What does that tell you? It tells you that in the world's largest gold market by physical volume, buyers are willing to pay significantly more than the official Western price just to secure actual metal. They're not interested in paper contracts. They want the real thing, and they want it now. And here's something that should really make you think. The LBMA, the London Bullion Market Association, which oversees the largest physical gold market in the world, has been experiencing something unusual. Their vault holdings, which typically remain relatively stable, have been declining. Not dramatically, not in a way that makes headlines, but steadily. Month after month, gold is leaving London vaults. Where's it going? East, to Asia, to the Middle East, to central banks and sovereign wealth funds that are converting their paper wealth into physical metal. You want to know what's really fascinating? The gold mining industry can't keep up. Global gold mine production peaked in 2018 at about 3,300 tons per year, and it's been essentially flat or declining since then. Meanwhile, demand has been surging. Central banks alone bought over 1,000 tons in 2023. Jewelry demand in India and China remains strong. Industrial demand for gold in electronics and technology keeps growing. And now you've got a new wave of retail investors and institutions who are waking up to what's happening and trying to get positioned. The math doesn't work. There's simply not enough new gold coming out of the ground to satisfy all these buyers. Let me share something with you that most people don't understand about gold mining. It takes 7 to 10 years on average to bring a new gold mine from discovery to production. 7 to 10 years. And that's if everything goes perfectly, which it rarely does. You've got to find the deposit, which is increasingly difficult because all the easy gold has already been found. Then you need permits, which in many jurisdictions can take years to obtain. Then you need to raise capital, build infrastructure, deal with community relations, environmental concerns, and 1,000 other challenges. The point is, even if gold prices double tomorrow, you're not going to see a flood of new supply hit the market for the better part of a decade. Now, here's where this gets personal for a lot of people. If you're sitting on retirement savings, if you've got a 401k or an IRA that's heavily weighted towards stocks and bonds, you need to understand what's at stake here. The traditional 60-40 portfolio, 60% stocks and 40% bonds, was built for a world that doesn't exist anymore. It was designed for an era of relatively stable inflation, predictable interest rates, and a dollar that everyone trusted without question. That world is changing, and it's changing fast. Quick aside here, and this is important. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical gold into your retirement account without triggering tax penalties, how the process actually works, and what you need to know before you make any decisions. It's worth checking out if this is relevant to your situation, because the window to position yourself advantageously might be shorter than you think. Anyway, back to what's happening in the market right now. The Federal Reserve is in an impossible position. They've got inflation that's still running hot despite their aggressive rate hikes. They've got a banking system that's showing cracks, as we saw with the Silicon Valley Bank collapse and the subsequent contagion. They've got a government that's running trillion-dollar deficits as far as the eye can see. And they've got a global reserve currency whose dominance is being actively challenged for the first time in 80 years. Every option they have is bad. If they keep rates high to fight inflation, they risk breaking something in the financial system. If they cut rates to support the economy, they risk unleashing another wave of inflation. And if they try to thread the needle and do nothing, they risk losing credibility entirely. Here's what history teaches us. In 1971, when Nixon closed the gold window and ended the dollar's convertibility to gold, it wasn't because the system was strong. It was because it was breaking. Foreign central banks were showing up at the Fed's door demanding to exchange their dollars for gold at the official rate of $35 an ounce, and the U.S. didn't have enough gold to honor those claims. So they changed the rules. They said, sorry, no more gold redemptions. The dollar is now backed by the full faith and credit of the United States government. And you know what happened next? Gold went from $35 an ounce to over $800 an ounce by 1980. That's a 22 times increase in less than a decade. Now, I'm not saying we're going to see a 22 times increase from current levels. The circumstances are different. But the underlying dynamic is eerily similar. You've got a reserve currency that's being printed in massive quantities. You've got foreign holders of that currency who are increasingly nervous about its long-term value. You've got geopolitical tensions that are fracturing the post-World War II order. And you've got gold, sitting there like it has for 5,000 years, as the ultimate form of money that no government can print and no central bank can debase. Let me tell you about something that happened in 2011 that most people have forgotten. Gold hit an all-time high of $1,900 an ounce in September of that year. Everyone said it was a bubble. Everyone said it was going to crash. And you know what? It did pull back. It went through a brutal bear market that lasted from 2011 to 2015, dropping all the way down to around $1,050. But here's what's crucial. The reasons people were buying gold in 2011, the concerns about currency debasement and sovereign debt and financial system stability, those concerns didn't go away. They were just papered over by central bank intervention and quantitative easing and a temporary return of confidence in the system. Fast forward to today, and gold is back above $2,000 an ounce. But this time, it's different. This time, the buying isn't being driven by retail investors panicking about the end of the world. It's being driven by central banks, by sovereign wealth funds, by institutional investors who manage billions of dollars and who have access to information and analysis that most of us can only dream about. These are the smart money players, and they're accumulating physical gold like their lives depend on it. And here's something that should really get your attention. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been sitting at historically elevated levels. Right now, it's around 80 to 1. That means it takes 80 ounces of silver to buy 1 ounce of gold. Historically, that ratio has averaged somewhere between 50 and 60 to 1. During the 2011 precious metals bull market, it got as low as 32 to 1. What does this tell us? It tells us that silver, which is both a monetary metal and an industrial metal, is dramatically undervalued relative to gold. And when gold starts to really move, silver tends to move even more dramatically. Think about the industrial demand for silver for a moment. Every solar panel requires about 20 grams of silver. Every electric vehicle uses between 25 and 50 grams of silver in its electrical systems. 5G infrastructure, medical devices, water purification systems, they all require silver. And unlike gold, which is mostly recycled and reused, silver gets consumed in industrial applications. It's gone, used up. Which means that industrial demand is constantly eating into available supply, while investment demand is simultaneously increasing as people wake up to what's happening in the precious metals market. Now, let's talk about what's happening with the US dollar on the global stage, because this is absolutely critical to understanding where gold is headed. The BRICS nations, Brazil, Russia, India, China, and South Africa, have been working on alternatives to dollar-based trade settlement for years, but it's accelerating. Saudi Arabia, which has priced oil exclusively in dollars since 1974, is now accepting yuan for Chinese oil purchases. The UAE is settling trade with India in rupees. Russia and China are using their own currencies for bilateral trade. These aren't just symbolic gestures. These are fundamental shifts in the architecture of global finance. And here's the thing that most people miss. When countries move away from the dollar for trade settlement, they don't need to hold as many dollars in reserve. And when they don't need to hold as many dollars in reserve, they need to hold something else. And what's the obvious alternative? Gold. It's liquid. It's universally accepted. It has no counterparty risk. It can't be frozen or sanctioned or inflated away. It's the perfect reserve asset for a multipolar world where trust in any single currency is declining. Let me paint you a scenario. Imagine you're the finance minister of a mid-sized country. You've got $50 billion in foreign exchange reserves. 30 billion of that is in US Treasury bonds, 10 billion is in euros, 5 billion is in yen, and 5 billion is in gold. You're watching what happened to Russia, where $600 billion in foreign exchange reserves were frozen overnight after the invasion of Ukraine. You're watching the US government add trillions to its debt every year. You're watching inflation erode the purchasing power of the dollar. What do? You start quietly converting some of those treasury bonds into gold. Not all of them, because you don't want to trigger a crisis or draw attention. But steadily, methodically, you shift your reserves toward assets that can't be weaponized against you. Now multiply that scenario by dozens of countries around the world, and you start to understand the magnitude of what's happening. This isn't a conspiracy theory, this is basic game theory. This is rational actors responding to changing incentives and risks. And the aggregate effect of all these individual decisions is a fundamental repricing of gold relative to fiat currencies. Here's something else that's happening that most people aren't paying attention to. The gold ETFs, the exchange-traded funds that allow investors to get exposure to gold without holding physical metal, have been seeing outflows. GLD, the largest gold ETF, has seen its holdings decline from over 1,200 tons at its peak to around 900 tons today. And you might think, well, if ETF holdings are declining, doesn't that mean demand for gold is weak? But that's exactly backwards. What's actually happening is that sophisticated investors are moving from paper gold exposure to physical gold ownership. They're taking delivery. They're moving metal into private vaults. They're converting their ETF shares into actual bars and coins. Why would they do that? Because they understand something crucial. In a real crisis, paper claims on gold are not the same as physical gold in your possession. If the financial system experiences serious stress, if there's a run on the banks or a currency crisis or a sovereign debt default, you don't want to be holding a piece of paper that says you own gold. You want to be holding the actual metal. And the people who understand this, the family offices and the high net worth individuals and the institutional investors who have seen crises before, they're moving now while they still can. Let me tell you about the COMEX delivery process, because this is where things get really interesting. When someone wants to take physical delivery of gold from a COMEX futures contract, they have to go through a specific process. They have to hold the contract into the delivery month. They have to notify the exchange of their intention to take delivery, and then they have to arrange for the physical transfer of the metal. Most futures contracts never go to delivery. They're settled in cash. But lately, we've been seeing an increasing number of contracts standing for delivery. People are actually demanding the physical metal. And here's where it gets concerning for the integrity of the paper gold market. The COMEX has two categories of gold in its vaults: registered and eligible. Registered gold is available for delivery against futures contracts. Eligible gold is stored in COMEX vaults, but is not available for delivery unless the owner decides to convert it to registered status. The amount of registered gold has been declining, while the number of open futures contracts has been increasing. At some point, if this trend continues, you're going to have more claims on gold than there is gold available to deliver. And when that happens, when the music stops and there aren't enough chairs, the price of physical gold is going to diverge from the price of paper gold in a way that makes the March 2020 dislocation look like a minor blip. Now, let's talk about what this means for the average person who's trying to protect their wealth and plan for the future. You've probably heard the conventional wisdom about portfolio allocation. You've probably been told to put most of your money in stocks and bonds, maybe keep a little bit in cash, and don't worry too much about gold because it doesn't pay interest or dividends. And in a stable, low-inflation environment with a trusted reserve currency, that advice makes sense. But we're not in that environment anymore. The real return on bonds, after you account for inflation, has been negative for most of the past few years. The stock market is trading at valuations that are historically elevated by almost any measure. The Shiller P/E ratio, which looks at stock prices relative to 10-year average earnings, is sitting above 30, which is higher than it was before the 1929 crash, higher than it was before the 2000 dot-com bust, and only exceeded by the peak of the 2021 bubble. And cash? Cash is being debased at a rate of 5, 6, 7% a year through inflation, which means that every year you hold cash, you're losing purchasing power. Gold, on the other hand, has maintained its purchasing power over centuries. An ounce of gold in Roman times would buy you a fine toga, a belt, and a pair of sandals. An ounce of gold today will buy you a nice suit, a belt, and a pair of shoes. The purchasing power is roughly the same. Gold doesn't make you rich. It preserves wealth. It's insurance against the debasement of fiat currency. It's a hedge against the kind of monetary chaos that we're increasingly seeing signs of. And here's the thing that most financial advisors won't tell you, because they're not incentivized to tell you. Gold has outperformed the stock market over the past 25 years when you account for real inflation. Not the official CPI numbers, which understate true inflation through hedonic adjustments and substitution effects, but real inflation, as measured by the cost of housing, healthcare, education, and food. Gold has gone from around $300 an ounce in 2000 to over $2,000 today. That's a nearly 7-fold increase. The S&P 500 has gone from around 1,400 to around 4,500, which is about a 3-fold increase. But when you factor in the loss of purchasing power of the dollar over that same period, gold has been the better store of value. Now, I want to be clear about something. I'm not saying you should put all your money into gold. I'm not saying you should panic and liquidate everything and buy gold bars and bury them in your backyard. What I am saying is that the traditional approach to portfolio construction, the approach that assumes the dollar will remain stable and trusted indefinitely, that approach is increasingly risky. And the people who understand monetary history, who understand how currency crises unfold, who understand the dynamics of reserve currency transitions. Those people are allocating a meaningful portion of their wealth to physical gold and silver as insurance against scenarios that are becoming increasingly probable. Let me share one more piece of the puzzle with you. The derivatives market for gold is absolutely massive. The notional value of gold derivatives, which includes futures, options, and over-the-counter contracts, is estimated to be in the hundreds of billions of dollars. These are paper claims on gold that far exceed the amount of physical gold that actually exists. And as long as everyone is confident in the system, as long as people are willing to accept paper claims as equivalent to physical metal, the system works. But confidence is a fragile thing, and once it breaks, once people start demanding physical delivery en masse, the entire structure can collapse very quickly. We saw a preview of this in the silver market in early 2021 with the whole Wall Street bets silver squeeze attempt. Retail investors, coordinating on social media, tried to buy physical silver and silver futures to force a short squeeze. And you know what happened? Premiums on physical silver coins and bars exploded. Dealers ran out of inventory. The spread between paper silver prices and physical silver prices widened dramatically. The squeeze ultimately didn't succeed in breaking the market, but it exposed the fragility of the system. It showed that the paper market and the physical market are connected by a very thin thread, and that thread can snap under pressure. So here's what I want you to take away from all of this. Something big is happening in the gold market. Central banks are accumulating at record pace. Physical gold is flowing from west to east. The paper gold market is showing signs of stress. The dollar's role as the global reserve currency is being challenged in ways we haven't seen since Bretton Woods. And the people who understand these dynamics, the smart money, the institutional players, they're positioning themselves right now. You have a choice to make. You can ignore what's happening and hope that the system remains stable, that the dollar remains trusted, that inflation stays under control, and that the financial markets continue to function smoothly. Or you can take some portion of your wealth, whatever amount makes sense for your situation, and convert it into physical gold and silver as insurance against the scenarios that are becoming increasingly likely. Not as a speculation, not as a get-rich-quick scheme, but as a prudent hedge against monetary instability and currency debasement. The window to position yourself advantageously is still open, but it's closing. When central banks are buying gold by the hundreds of tons, when physical premiums are spiking in Asia, when registered COMEX inventory is declining while open interest is rising, these are warning signs. These are signals that the people who have the most information and the most resources are preparing for something. And if they're preparing, maybe you should be too. The choice is yours. But don't say you weren't warned. Don't say you didn't see the signs. Because they're right there in front of us if we're willing to look. And the people who act on this information now, while gold is still available at reasonable premiums and while the system is still functioning normally, those are the people who are going to be protected when the music finally stops and everyone realizes there aren't enough chairs to go around.